Hi, and welcome to this week's episode of the Stockscores Market Minutes. This week I want to talk about some of the reasons that stock traders fail. Most stock traders fail, and it comes down to a few simple things, hard to do, but simple things that you have to overcome. So I'm going to walk you through a list, describe those things, maybe give you some ideas on how to overcome those failures. So let's jump into the list now. Why stock traders fail. The first thing on my list is no edge. What does that mean? Well, in order to do well in the market, you need to have an edge over the other traders in the market. Now, you may have a good indicator, you may have great risk management, you may have inside information, which is illegal to trade on, but some people do that. You may have really fast execution. There's all kinds of things that can give you an edge. So my edge tends to be that I've got some great indicators, strategies that I've developed over the last 25, 30 years that just consistently highlight the stocks that have the best potential. You can learn more about that at my website, stockscores.com. But let's get into the second thing on the list, and that is no plan. You wouldn't build a house without a plan. You wouldn't go on a trip without a plan. In order to be successful in the market, you should have a written plan. Now, here's why a written plan is important. In the heat of the moment, particularly when you're day trading, maybe even swing trading, where you have to make fast decisions, the great challenge you will face is overcoming yourself. When we get the pressure of money on the line, financial risk, it's very easy to go into a panic, into fight or flight mode. There's two parts of your brain that are competing for the decision making in that situation. There's the prefrontal cortex, which is our thinking part of our brain. That's the one you want to use. The problem is, when you go into fight or flight mode, your amygdala takes over. And in fight or flight mode, amygdala is just trying to save you from yourself, basically, or save you from danger. It's what makes you run away from a tiger. Well, we don't want that in trading because it's going to cause us to make really bad decisions. We can go almost into what poker players call tilt mode, full tilt, where you just lose your mind, you become a full-on gambler, and you make bad decisions. Now, how can you overcome that? By having a written plan with a checklist of your process to evaluate and execute a trade. Now, the plan isn't any good if you don't have an edge, if you don't have a strategy that is effective. So you need both. If you have a good strategy that you've tested, that you know works, and then you have a written plan to follow in the heat of the moment when you get a little bit stressed or anxious about the money, then you're going to do better. All right, the next thing on the list is the FOMO. You've probably heard about FOMO, the fear of missing out. The fear of missing out is what causes retail traders, rookie traders to chase stocks higher. As they start to go up, as you see the action building, it's very easy to get caught up in the emotion of, wow, the stock is going up. I should have bought it before because I would have been able to get in at a much lower price. Now it's running away. I have to chase it. And what tends to happen in that situation is you're buying a stock that is going parabolic. The crowd is on it. You're not ahead of the crowd. You're in the crowd. You're chasing the stock higher. And that typically happens right before the bubble bursts. And so you don't want to be a FOMO trader. Again, you have to have a plan based on a strategy that's proven and not get caught up in the emotion of a hot stock as it rips to the upside. All right, next one, poor risk management. We all have a emotional attachment to money, or most people do. And in that, you can take on too much risk, more than you can tolerate. And when that happens, you don't have a willingness to take losses. So let's say you take a trade and the trade doesn't work and you're down $500. If your risk tolerance, what you can sort of do without getting too emotional, is $200, you've taken on too much risk. Because now that the trade isn't working and you're down $500 where you were maybe willing to lose $200, you're not going to take that loss. You're going to hang on and hope that the stock turns around. Well, guess what? Hope is not a trading strategy. Hope is a fast way to lose a lot of money. So you have to take a position size that reflects your tolerance for risk. And when the trade doesn't work, and everyone is going to have losing trades, when it gets to that point where you've been proven wrong, you got to take the loss and move on. Next on the list, averaging down. This is a place that people get into where they're trying to escape the pain of having a losing trade. Maybe they bought that trade where they shouldn't have, or they didn't want to lose more than 200. Now they're down 500. They're trying to fix a couple of bad decisions. And so what do? They buy more of a loser. Never, ever, ever buy more of a loser. Never, ever average down. There are some people that get away with it, but in my experience, they might get away with it once in a while, but generally speaking, it's a bad thing to do. You want to average up. If the trade's working, maybe add some more, as long as it's not going beyond your risk tolerance. But when the trade isn't working, don't add more. If you were into betting on horse races and you bet on a horse and your horse is in last place, would you go and put more money on that horse if you could? No, your horse is not working. It's not going to win. Same thing with trades. If you're in a trade that's a dog, don't buy more of it. Go find a better trade, something that's working. And if anything, take the money out of the loser and put it into the stock with the better potential. All right, a couple more here. Patience with losers. People, don't want to take the pain of suffering a loss. And so instead of taking that early loss, the small loss, the manageable loss, rookie traders, failing traders will have patience with their loser. Now, the other side of that is they don't have patience with their winner. You could have a winning trade, it's up $1,000. There's no sell signal, but it feels good to lock in that profit. You worry that your winner is going to turn into a loser because maybe you've had some losers. You don't want that bad feeling of having a winner turn into a loser. I'm not saying don't sell a winner. Absolutely. When there is a sell signal, sell a winner. And that's all part of your strategy that you've researched and tested. But if a trade's working, let it work until it ceases to work and until you got to get out. Because I've seen trades where, they go up 2 times risk, and then I've seen trades go up 15 times risk. And those big winners are going to pay for some of your losers. So make sure you stick with the winners and cut the losers fast. So that's my list there. Why stock traders fail. Again, no edge, no plan, FOMO, poor risk management, averaging down, patience with losers, and no patience with winners. All right, let's get into this week's Stockscores analysis of the overall markets. We're going to jump into my website, Stockscores.com, to see what the charts of the indexes are showing us. Before we get into the charts of the indexes that we follow, just a reminder, if you go to Stockscores.com, you can register right here for my free weekly email. And in this email, I send out stock picks and general commentary on how to trade better. All right, let's get into the first chart, which is the S&P 500. And you can see there the trend is up. This was when tariff talk began, trade wars began, but the markets made back all of these gains. Now, there's a caveat to this, and I'll show that to you in a moment. But for now, we can say this is a bullish market in the short and long term. Moving along to the NASDAQ, QQQ is the symbol. Very similar chart there. Its trend is up. If you look at the short-term time frame, this is the 1-month chart, generally trending upward. It's sort of a melt upward, drift upward as opposed to an exuberant buyer's market. But nonetheless, we are still in the upward trend. Now we'll move along to the small cap sector, and that one has lagged the larger cap stocks, and the main culprit there remains higher interest rates, and we'll look at the interest rate chart in just a moment, give the outlook for that. All right, moving along to the Canadian market now. T.XIU is the symbol for the TSX 60, and it too is in a sort of gradual, slow upward trend. How about gold, GLD? Well, gold had a great run. You can see it better on the 3-year chart. Just this huge move from early 2024 up until it topped out in the spring of this year. It's been going sideways for the last 3 or 4 months, so it's more or less neutral in the sort of short and long term, but the very long term trend is still up, and we could see this continue. Now, one issue here is that we are still far above the trend line. Let me draw that in blue. So there is your upward trend line, and when price runs away from the trend line, it usually has to come back to the trend line. Now, it can come back either by going sideways for a while or by correcting downward. This gold chart seems to be in the process of just coming back to the trend line sideways. At that point, it can either break down, break the upward trend, or resume, and of course we have to watch for that. For now, it's still a good hold if you're in it, but I wouldn't be buying it here. All right, let's move along to oil. USO is the symbol. Very volatile chart. Volatility is an indication that investors are uncertain. So there's a lot of uncertainty around oil. If we look at the 3-year chart, it's been stuck in a sideways range for a number of years. It just sort of oscillates between these highs and lows. And right now we're kind of in the middle of the range. So, companies have a predictable price, which is good for oil companies, but there's certainly not a growth in prices, which would be good for the earnings of oil companies. And therefore, I'm not too excited about buying them. All right, let's move along to the US dollar. And there you can see the real strong downward trend in the US dollar. And that's the caveat that I put on that S&P 500 and NASDAQ 100 chart, is that, you may see your value of your holdings in US stocks go up, but keep in mind that the US dollar is falling. And so that actually takes away some of the gain that you're enjoying on US stocks if you are a foreign investor. Now, if you're an American in the American market, you don't really feel that. Perhaps when you go to buy foreign products, your buying power goes down somewhat. But in terms of your stock market holdings, those are climbing. But for the rest of the world, it's not climbing as much because of the weakness in the US dollar. All right, moving along, let's take a look at Bitcoin, GBTC. And the trend here is up. It's also kind of volatile. If we look at the 3-year chart, it's in a nice upward trend, but choppy, right? It goes up, it pulls back, it goes up, it pulls back. Now we're on the up move. We should get a pullback soon to take price back to that upward trend line. It's a good hold if you're in it, but buying it here, you're buying it at an overbought condition. The reason we can say it's overbought is there's your trend line. Anytime you're far above the trend line, you're overbought. And so we see that here again. It's likely to pull back soon, but if you're a long-term holder, you just ride that out. If you're a short-term trader, you might profit from those swings. All right, last chart is TLT, and that is our bond market. Actually, I'll take a look at the silver chart because I've had a few requests for that as well. But here's the bond market, generally down, but over the last 2 or 3 months, sort of stabilizing. If we look at the 3-year chart on bonds, you can see the general pessimism over the last number of years, falling tops. There's a sign of pessimism. Now, keep in mind, when the bond market is going down, that means interest rates are staying elevated. And in the bond market, interest rates are relatively high. We're not getting that prediction of lower U.S. interest rates. The rest of the world has dropped rates. The U.S. has not. And as a result, we have this sort of negative bond chart. What we need to see is this downward trend line broken. If instead we break down through this floor, then that implies even higher interest rates for the U.S. market. So my ratings then, bullish on both time frames for all stock markets, gold neutral on both time frames, oil neutral on both time frames, US dollar short-term neutral but still long-term bearish. Sticking with my bullish rating, short and long-term for Bitcoin, but I wouldn't be surprised if we get a little pullback. We just don't see the sign of one yet. And then on bonds, neutral on both time frames. All right, now I want to take a look at the trade of the week. And this is an interesting one because it gave so many entry signals throughout the trading day on Friday. In the pre-market is when it all started. You can see right here in the pre-market, we started to get our message candles and action candles firing, and that led to the first phase of the move, which was, from around $2 to $4.50. It's hard to believe that that's how much it moved there, but yes, in the pre-market, it moved from $2 to $4.50. And then coming into the normal session, it drifted lower. My comment to my active trader subscribers on Stockscores was to give this stock some time, let it stabilize, and wait for the buyers to come back. And we saw that starting right here. There's a little yellow dots there, and I know that with the scale so skewed, it's hard to see these, but if we were to zoom in on those, we would see those action candles firing. And then a big one right there, which was breaking through resistance from optimism. That was the next phase of the run, which then got another confirming signal there going into the close of trading. Now this one was really wild because in the aftermarket, after the market closed, it also did another entry point right here, around 5:20 Eastern time, and that led to the next big phase of the run. And at the end of the day, the stock started in the pre-market in the $2 range, and it hit just shy of $13 in the aftermarket. So a huge percentage gain. And these are the kinds of trades that we love to find, focusing on abnormal trading activity, using my action candle indicators to find these things early in the moves, whether it's the pre-market moves, the regular session moves, or even the aftermarket moves Not all stocks do it like this, but this one is a great example of how some stocks make moves in all trading sessions. Well, I hope you've enjoyed this week's Stockscores Market Minutes. If so, do me a favor, click on the like button, subscribe to the channel, and as always, trade well.